We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jeff Snider, Head of Global Research at Alhambra Investments. Thanks for joining me today, Jeff.
Thanks for having me, Tom. I look forward to it.
Me too. I've been, a follower of your work for a while, so it's great to actually, be able to speak with you finally. So why don't we start off with, a big topic, and that would be inflation, and let's say its causes. I've heard you say before that we don't have the monetary component, which would turn it into actual sustained inflation over time. So does this disparity emanate from how we define inflation, as in expansion of money supply versus consumer price and appreciation, or is it the nominal measurement or the year over year comparison to last year's numbers?
Oh, inflation is such an emotional topic to begin with, quite understandably, because, it impacts directly your own personal finances. And, if you go to the grocery store or the gas pump and prices are a lot higher, obviously you're going to be thinking about inflation very differently, very personally, less dispassionately than maybe somebody in my position who is analyzing these and through the lens of, macroeconomic factors, monetary factors, and things like that. And so it's often a difficult conversation for that very reason. Mm-hmm. But we like to, let's be specific about what we're talking about, which is inflation, which is always and everywhere a monetary phenomenon, which means, when we talk about what is that monetary inflation, it is when consumer prices increase in advance across a broad sector of consumer goods or services, most likely both, and that it's sustained for a prolonged period of time. So it's not like, just food prices go up for a couple months, or even just a lot of prices go up for a few months, or even maybe 6 months or half a year, but that almost every price that you pay at wherever you're shopping or whatever you're doing, services, goods, whatever, they go up a lot, and then they go up year after year after year after year. That's really the inflation, textbook inflation definition that we're using to analyze whether or not we're actually experiencing textbook inflation. And as I said, in order to get to that point where you get sustained increases in a broad-based consumer price advance, it comes from too much money chasing too few goods. That's the old cliche or adage that's been used for who knows how long. And if you don't have that monetary growth or that monetary increase, and in consumer prices do bulge like they did in the first part of this year, you can't say that's inflation. It's something. It's obviously something has happened. Consumer prices are reacting, but not everything about consumer prices has to be inflationary. It could be something else. And if there isn't the monetary indication there, then you have to start looking in other places for the explanation of what has happened.
So as we think about, let's say, the monetary component of that, Jeff, what piece of that is missing for this to be, let's say, sustained over time? We've seen, we've all seen the lumber chart gone straight up, iron, PVC. There's countless examples of commodities that eventually trickle down into the PPI, which you would think ends up trickling down into the CPI. So what is the monetary component piece of the inflation puzzle that we're missing?
Yeah, and I think that's the right way to look at it. What are we missing? My answer is pretty much everything that matters. Because look, you can understand why there's this misconception out there. Mm-hmm. Not just commodity prices, which are generally thought to be an inflation hedge and therefore a signal about inflationary conditions. But again, they could be rising for other reasons. As you mentioned, lumber went parabolic, and then it went parabolic on the way back down. Copper prices went parabolic, and now they're substantially lower and maintaining lower than where they were. So maybe there are transitory factors. But on just, the monetary side, getting back to that part, we're missing everything. And again, you can understand why the public doesn't know that. The vast majority of the public doesn't know this, because what you do see and what you do hear about the monetary system is the Fed. QE, bank reserves. So you can see the central bank's balance sheet explode. You can see the level of bank reserves explode, and you think, money printing, there it is. It's right there in front of everybody. How can you possibly say there is no monetary background for inflation? It's right there on the Fed's balance sheet. And that's where we get into this Eurodollar shadow money story, which is Bank reserves are not money. They are a unit of account that has a very limited purpose inside the banking system. And therefore, you're sort of being misled into believing the Fed is actually printing money when in flooding the world with digital dollars, as Jay Powell said on 60 Minutes last year. That was an outright lie, and he knew it. Bank reserves are not money. And that's really the only thing that has flooded the global system, especially the US system, is bank reserves. And so what are bank reserves? What role do they play in the actual effective monetary system? And most people are surprised to learn they don't have much of a role at all. In fact, for decades before we ever got to 2008, this Eurodollar shadow money system developed all forms of liquidity and money and cash-like equivalents that had absolutely nothing to do with the Federal Reserve or bank reserves. So you have this entire system out there lurking in the shadows, doing all of these things, whether they be inflationary, deflationary, certainly deflationary post-crisis, regardless of the Federal Reserve's monetary policy, independent of the level of bank reserves. So what I often tell people is, look, yes, you can see the Federal Reserve's balance sheet explode, but that's a reaction function to something else in the shadows. In other words, it's what you can't see that actually makes all the difference, not what you can. Because when you see the Fed do something like a QE where it raises the level of assets and bank reserves, that must be in response to this deflationary money that's taking place in the shadow money system that you can't see. So even just on a surface analysis, you can't judge the monetary condition by the Federal Reserve's bank reserves or its balance sheet alone. You have to look at that as a small part of what's going on in the shadows, which is likely much more, if not always, more important than what the Fed does.
Mm-hmm. You touched on the Eurodollar idea there, and I'd like to get to that, Jeff. But before that, I have a couple more, just let's say, clarifications on the inflation story. So, what are the camel humps in the inflation curve, and how do we go about thinking cause and effect of that market behavior?
Yeah, I have to thank my co-host, my podcast co-host, Emil Kalinowski, for the camel humps. I think that's a pretty good way of saying it. Mm-hmm. What we see in the PPI, the CPI in the United States, and again, this is only the United States, which is already a clue that this is not inflation. Because inflation, in addition to being a monetary phenomenon, it's a global phenomenon, because what we're really talking about is a global monetary system. So if you see these idiosyncrasies like the US CPI going way out of whack, where nobody else is following it, Europe, Japan, wherever else, China, then you're already on guard and thinking something else is going on here. And we start to look at what that something might be. You see these camel humps, which are inflation in the United States, whether it's a PPI, CPI, PCE deflator, whatever your favorite measure is. They're all flawed anyway. The PCE deflator, CPI, they bulged in the summer of 2020 for the first time. Mm-hmm. Then inflation pressures backed off. The indices came down. And for the rest of 2020, they were very limited. In fact, somewhat outright deflationary in services and things like that. And then we had a second hump that started around February and March of 2021 that reached a peak in April and May. And now we're kind of on the other side of that camel hump there. And when you line those things up on the calendar, what you see is quite clearly they match up perfectly with, number one, reopening the economy after pandemic-related shutdowns. That was the summer of 2020 as well as early 2021. And in addition to those, you have heavy doses of the Treasury Department's helicopter, which was direct payments into people's bank accounts. And so what you see is that, yes, even large government spending, fiscal helicopters, whatever you want to call them, they can have effects on the real economy and real consumer prices, but they don't tend to last, which, again, because you wouldn't expect them to do unless you're a neo-Keynesian economist who thinks that there's a positive multiplier here. And so you have these temporary factors, along with supply bottlenecks and logistical nightmares in the supply chain, which are creating these temporary factors that we're already seeing in these camel humps and these various U.S. inflation indices.
And again, when we think about, let's say, looking at a chart of those camel humps, this is the nominal or the comparison figure that we're looking at compared to last year, right?
No, we're actually looking at the index as well as, say, the month-over-month change. So you can see the index bulge where, it kind of goes along flat because we were in a disinflationary period before then. Then all of a sudden, Uncle Sam and reopening in 2020, and the index kind of jumps, and then it goes back down to like this. And then, of course, in 2021, it jumps even more. But now we're starting to see the index itself hook back lower. Mm-hmm. And, of course, as you were alluding to, that distorts, base effects in the year over year comparisons, and some of those get to be some of those have looked obscenely high, like the PPI commodity index in the United States, which is the annual change up near 20%, which is the highest since the mid 1970s, which again gets people thinking, this is real inflation here. How can we not? We're comparing something to the 1970s. How can it be anything else? But when you analyze it on a much more granular level, or in terms of the indices themselves, you see these camel humps, and then you think, yeah, there really were large but transitory effects especially again, only the U.S. economy. You can't see these things outside of the U.S., which means not global money, but localized individual country or individual national characteristics, which in this case are easily identifiable.
Mm-hmm. So when we think about how a central bank like the Fed is borrowing or printing dollars into existence through programs like QE 1 through 6, let's say, if we take a different example and using the Bank of Japan, that's on their 23rd iteration of QE, why doesn't it have the desired effect? And what is typically, let's say, misunderstood about these programs?
Well, because what you just said, the Fed is printing dollars, and therefore you would expect those dollars to have some kind of economic impact. But what the Fed actually does, as I said before, they print bank reserves, which are not necessarily the same thing. And so you have to, we're conditioned to just believe that bank reserves are money and that the Fed prints money, and that's what it does. And that's part of the intent here. The intent here is called expectations policy, which is to get you to believe things when those things may or may not be true. And so you really have to take a step back and look, what is it the Fed really does here? What are they actually doing with these quantitative easing? Even the name itself, right? Mm-hmm. Quantitative easing. It's meant to evoke certain emotions in you when you hear it. Easing. I mean, that's money printing, right? And quantitative. So it's scientifically determined to be the right amount of money printing. And that's what the name was designed for, mm-hmm. to register that sort of emotional impact in your brain so that you don't think too much more about what the Fed actually does. What are these stupid bank reserves? What are they actually for? And you're right, Tom, when you look at the Bank of Japan has been doing this for over 20 years, which is already an alarm, right? If this is scientifically determined to be the right amount of money printing, why are you even doing it twice? Shouldn't the first one have been enough? Mm-hmm. And so if you're continuing to do this after, 10 years, 20 years, whatever it might be, already you're thinking something's not right with what we're told about what's going on here. And then when you examine what the Federal Reserve does, you examine what bank reserves can be used for, they don't actually print money. That's why the dollar never crashes. That's why inflation never gets out of control, because it's all a lie. It's all a lie of omission. The Fed is not printing dollars, they're printing bank reserves. And that sounds like a trivial distinction, but it really is everything. And as I said before, the Fed wants you to believe, look no further than its balance sheet. When again, you should be looking toward the monetary shadows where actual money gets done. And if you look at those shadows, or at least what's going on or how they're impacting the world and the economy, then you start to realize why all this bank reserves and money printing and Fed stuff has really just been nothing more than smoke and mirrors for so long. And that's why, you can't use smoke and mirrors to solve a real monetary shortage. And that's why Japan or the Fed, they have to keep repeating these time and time again, and they don't ever lead to the desired effects because it's not actually what people think that it is.
So when we think about this from let's say a different way, Jeff, is like if they're printing a bunch of bank reserves, in a way that currency, let's say, isn't getting into the economy, thereby not creating
literally cannot
velocity.
Go in it. Right.
Right.
I can't use a bank reserves to go buy groceries. Mm-hmm. I can't get my hands on a bank reserve. It's a specific accounting function that is available only to the banking system. Mm-hmm. Only banks can have bank reserves. Only depository institutions can have accounts with the Federal Reserve, and therefore it is really it's really kind of an accounting issue for the banking system. And if it's just for the banking system, it doesn't touch the real economy in any way, shape, or form, then it cannot be dollars. It cannot be actual money. And that's where you really have to start your analysis is realizing that these bank reserves are an interbank sort of quasi-statutory thing that is not real money. And I know in a lot of places you're taught, well, this is base money. It's not even money. It's high-powered money, as Milton Friedman once said. And that's just not accurate. It's not the way the system actually works.
So what's the point of them then? Is it to increase liquidity between these banks or these large entities?
That is one kind of purpose where they actually do have a sort of legitimate function. But at some point, you can create a few additional bank reserves, and that's enough. Mm-hmm. You don't need to create trillions upon trillions of bank reserves, because then you're just stuffing wasteless bank reserves into banks that don't want them and don't have any real use for them. And so the point is exactly what we just said, which was to get people to believe the Fed is printing money, because the Fed actually thinks if you believe the Fed is printing money, then you will act on that belief. And then that will create the self-fulfilling prophecy, right? If you believe the Fed is printing money and that's inflationary, I'm going to start doing things today as if inflation will come. Therefore, that will lead to inflation down the road. They really believe this expectations policy. They don't need to print money, but if they fool enough people into believing that they're printing money, guess what happens? Well, nothing happens, but they believe something happens. And that's really the problem here. So the purpose of bank reserves are to create inflation expectations, which is a very, very, very different thing than printing money.
So when we hear about programs like the RRP or the reverse repo program, we've seen it recently. I believe it was reached a high of $1.5 billion in one day, something like that. Is this
$1 trillion?
Okay, my mistake.
Big number.
It is a big number. Huge. But is this a program designed just to serve and mop up some of those bank reserves and deal with this expectationary policy?
Yeah, they've created so many bank reserves that they don't have any use for them. And so one of the uses is, you can lend them out in repo or some others interbank market mechanics. Mm-hmm. And if there's not enough collateralized borrowers in the marketplace, what else are you going to do with all these bank reserves? And the Fed says, is we've created all these bank reserves, we're going to take them back from you on a daily basis in this reverse repo program. So essentially, a bank that has a lot of bank reserves has all these excess bank reserves on its balance sheet, rather than lending in repo or some unsecured markets that don't really exist much anymore anyway. They can lend cash that these bank reserves that the Fed created, back to the Federal Reserve. That's how ridiculous it is. It's essentially a shell game to make, number one, we're creating bank reserves to get people to think we're printing money. But number two, that actually causes some interbank distortions that these technical distortions that we have to take care of. Mm-hmm. And it's really kind of a shell game at that point.
So, Jeff, to move back to the euro dollar equation here, how does it play into all of this? And if it's let's say a deflationary force, which one is stronger, the inflation that we're seeing or supposedly seeing in the dollar versus the euro dollar deflationary picture that you say that there's a problem with, that has basically I know from doing research for today that you say that problem has basically opened up in 2008 and has never really been fixed, right?
Yeah. And so really that's a two-part question. Number one is, why does the euro dollar and the shadow money matter? Mm-hmm. And I think this is another huge misconception that people have, because they think, 1971, August of 1971, President Nixon closed the gold window and therefore ended Bretton Woods. And what replaced it was the US dollar as the sole global reserve currency. And while that's technically true in terms of the denomination, it is completely false in terms of what has actually happened. The Eurodollar system, which is an offshore bank-centered monetary system, actually absorbed the roles of the reserve currency long before Nixon took action in 1971. And so throughout the 1960s and the early part of the Great Inflation, this Eurodollar system had already taken on liquidity and adjustment functions of the global reserve currency. So even though it's technically denominated in the US dollar, these are not US dollars. These are bank liabilities and bank assets, virtual ledger currency. There's no actual currency. It's a virtual reserveless currency system that actually is the global reserve currency standard. So that already answers the question why you should care, because the effective global monetary system is this shadow money. As hard as that may be to believe, and how, it sounds preposterous because it's not what we've been told for a long period of time, but yet it doesn't take very much research and scholarship at all to go back in time and say, yes, to establish this is what actually happened. The Eurodollar absorbed the roles of the Bretton Woods system as it failed, as it was unable to circumvent Triffin's paradox. And long before President Nixon acted in 1971, it had already become the global reserve currency. So that answers the question why everybody should care, because it has been the global reserve currency. It has been the financial and monetary agent for the wave of globalization that swept up over the global economy up until 2008. And by the way, it is also the reason we had a global financial crisis starting in August of 2007, because it wasn't about subprime mortgages. It was about a global euro-dollar shortage. We had a monetary collapse in the monetary system, this global monetary system, the shadow money system that the Fed was powerless to do much about, which is why we had this 2-year-long crisis that was so devastating to not just the US, but again, the entire global economy. And then the third part of that is that the 2007-2008 dollar shortage was not a one-off temporary event. It represented a systemic rupture in the function of the system. And so ever since August 9th, 2007, the Eurodollar system has been malfunctioning at best, and sometimes it becomes a very serious dollar shortage problem. So repeatedly over the last 14 years, we have these dollar shortage situations that become very serious, and that has robbed the global economy of legitimate economic growth. That's where your inflation has gone. That's why we've had nothing but disinflation, and in some places around the world, outright depression and deflationary conditions, because the global reserve currency system has been persistently malfunctioning for 14 years. And you can't use the Federal Reserve's bank reserves to fix that, because it's all just a fiction. When you have a real monetary shortage, real systemic problem, the Fed is ill-equipped, and they know it. They're ill-equipped to handle. So that's the first. Why do you care about the Eurodollar system? And then the other part of your question is, okay, the Fed does all this QE, which really doesn't matter. It's supposed to have some sentimental effects, which even those have diminished over time. And by the way, this is not my determination. You can check for yourself. Go to any central bank's website and look up their scholarship on quantitative easing. And what you'll see is that in paper after paper, study after study, they admit QE doesn't work in any of its proposed channels. They tell you it does not work. It doesn't lower interest rates. It doesn't make banks rebalance their portfolios. And it doesn't really work through the expectations channel either. They will say that to you, but they don't want you to know that. They want you to continue to believe in this stuff. So you have that as supposed to be the inflationary monetary conditions on the one side. And then on the other side is, again, what you can't see in the shadow money system. And because we can't see it, how we analyze it is through what happens in other very related markets. Things like, Eurodollar futures, for example, which are a hedge against 3-month LIBOR. They're settled in 3-month LIBOR. So it's the monetary system, or at least the agents and the financial banks that are in the monetary system, giving you a sense of what they're seeing that you can't see. So we can't observe the Eurodollar system directly, but we can kind of observe, and we can, in some cases, very good observe what the actual monetary agents are thinking and what they're seeing. So that's, things like the Eurodollar curves, things like the US Treasury yield curve, the behavior of nominal and real interest rates and things like that. So we can get a sense of what must be going on in the shadow money system by what's happening in all these other related markets. And over the last, certainly 6 months, what we've seen is as inflation expectations in the media have gone through the roof, actual inflation expectations, which never got very big, very high to begin with, have been going in the other direction. And I mean that in terms of growth and inflation expectations, you would decompose the nominal treasury yield, which suggests that, yes, the Federal Reserve's balance sheet has gone way up. Bank reserves are added a couple more trillion to them, but the real money, shadow money system it's still malfunctioning, it's still deflationary. And that's the one you need to pay attention to.
So Jeff, can you just lay out for us again, what happened in 2007, 2008 that broke, and how could this actually be fixed?
How much time do you have? It's really, it sounds like it should be a really easy question, because in many ways, you step back and look at what happened. The global financial crisis was nothing more than a historic, a bank run that you would see throughout history. Mm-hmm. But the problem is it wasn't in the ways that it wasn't. They're very unfamiliar to most people, and indeed most quote unquote experts who don't understand that this was a bank run where the only panic was banks panicking in these interbank markets. In a way, it was just the confidence that the banks had in each other, right? That's what money is. Money is all about confidence. It's always about confidence. And that's really the point. Gold, historically speaking, maintained itself as a monetary agent, and the money in most systems, gold or silver, any kind of precious metal, simply because of that confidence. And it wasn't just that its physical properties meant that it wouldn't erode. The fact that it doesn't erode instills confidence that you have a solid store of value. And so money is always and everywhere about confidence. And what happened, not to chase this too far down the rabbit hole, but just in big generalized terms, throughout this Eurodollar evolution from the 1950s on forward, you had these vast changes to what money was. And that's one of the problems the central banks faced in the 60s and 70s. They realized that banks were doing all these different things and experimenting with all these different monetary forms they couldn't keep up with. And that's why they turned to this expectations management policy, because they realize we can't do money anymore. We don't even know what it is because the banks are doing all these different things. There's repo, there's derivatives transactions, currency swaps, and all this really complicated stuff that in every way acted like it was a monetary form. And the central bank said, we're out. We can't do this. So we're just going to pretend that we do money and hope people buy the fiction. And for a long time, it seemed to work. We had that quote unquote great moderation for the 80s and 90s and middle 2000s, that it kind of seemed like everything was working really well. And that included the Eurodollar system itself. But the Eurodollar system was not a really stable system. And it only appeared to work so long as it was growing exponentially. And that, of course, maintained the illusion that the Federal Reserve, Alan Greenspan, was in charge with his ridiculous puppet shows of moving the interest rates around a quarter point here and there, as if he could fine tune a global economy that easily, right? Mm-hmm. So what really happened was all of those inherent flaws in this unstable Eurodollar system sort of kind of bunched up together in 2007 and 2008 and caused essentially a crisis of confidence, which, again, with no place for the Federal Reserve to stand behind it or any central bank to really stand behind it, you have a crisis of confidence. There's no way out of it. It's going to reverse. It's going to implode at some point and create all sorts of economic and financial damage. And there's, I'm being very generic for a reason, because, if you go into any of the specifics like collateral or credit default swaps, regulatory capital relief, things like that, these are really complicated topics that do require a lot of discussions to really understand how the system was so unstable before we got to 2007, 2008. But when you do that, what you see is, okay, now I understand why it broke in 2007 and then never got fixed afterward, because there really was no way to fix. Once the horses are out of the barn, you can't get them back in so easily. In fact, in this case, it's literally impossible.
Mm-hmm. So what does the US TIC data show us? And how is this a symptom of exactly what you're telling us?
Well, the TIC data is essentially the Treasury Department, again, going back into the 60s and 70s. Economists and central bankers back then took a more pragmatic approach to this global money. They didn't know what banks were doing. They couldn't define money, but they knew that there was this offshore Eurodollar system, and maybe we should take some interest in what's going on here, because maybe that's kind of important. And they already knew it was important. They already knew it was screwing up the monetary statistics as well as the monetary condition in the 70s. So the Treasury kind of took a stab at, we're going to look at what banks do, and we're going to look at foreigners do with offshore dollars investing in domestic assets. And that's really what it tracks. There's the bank data where banks, they lend money to the Eurodollar system and they borrow money back from the Eurodollar system. They lend collateral into the system. They borrow money back from the system. Foreigners have US dollar balances available to them. Some of those foreigners like to invest those Eurodollar balances in especially US Treasury assets. And that's kind of what people are familiar with TIC. It tracks, foreign demand and foreign purchasing activity of US dollar assets, primarily US Treasuries, which are popular with foreign reserve managers. So what you see is that, generally speaking, that when the Eurodollar system is working and seemingly functioning well, there's lots of Eurodollar resources out there in the rest of the world, that we find that foreigners tend during those times to buy a lot of US dollar assets, which would make sense, right? If there's an excessive amount of US dollars out there in the world through this Eurodollar creation, a lot of those would find their way back into the US dollar assets. And so that correlates exactly what you see in the TIC data. Before August of 2007, foreigners were buying up tons and tons and trillions of US dollar assets, primarily treasuries, because that was what they did. And even, Ben Bernanke couldn't deny that this was going on. He just had to downplay its significance he called this a global savings glut, as if this was baby boomers in Europe worried about reaching retirement. And just for some reason, he can never explain they like to buy US treasuries with their savings for retirement. So this was a very real phenomenon. And during that period, excessive dollars, we see foreigners buy a lot of US dollar assets. Now, when dollars start to get tight, as they did in early 2000 or late 2007, early 2008, obviously you would think, well, there's fewer dollars floating around outside, fewer excess dollars floating around outside of the United States. Therefore, foreigners can't buy as many US dollar assets as they like. So in the TIC data, you're going to see foreigners buy less US dollar assets. And when the conditions in the euro dollar system get really bad, real full-on global dollar shortage, they have to actually outright sell their US dollar assets in any particular month or group of months. And so that's what we correlate. When you see foreigners buying lots of US dollar assets, that's more normal euro dollar behavior. When you see them buying less US dollar assets, that's a warning sign. The dollars maybe aren't as plentiful as they should be or would be or normally would have been. And then when you see foreigners actually selling, which has become a frequent thing, especially over the last couple of years, that's an indication, a warning bell that, hey, there's something wrong. There's a tight money in the euro dollar system, not a flood of dollars as we're led to believe. And that's really what we've seen over the last couple of months. The latest data for July, as well as the month of May, recent TIC data has shown there's selling in US dollar assets, which is, again, that's not a good sign.
So just to kind of wrap all that up a little bit better, Jeff, if there's selling in this euro dollar market, that ends up being a deflationary pressure on the US. Is that right?
It's an indicative of again, because we can't observe what's actually going on. It's right. A symptom that you look backward, we're reverse engineering what must be going on. Mm-hmm. We're drawing the reasonable conclusion that if foreigners have to sell their US dollar assets, it's because they're short of dollar funding outside the United States. And therefore, the one is a symptom of the other. Now, we can't directly observe this. And so we're not using the TIC data alone. We're using the TIC data in concert with market data. It paints this comprehensive picture. Oh, okay, yes, this must be the case. The TIC data agrees with this other data, which says the dollar system is being deflationary, not inflationary, and it's causing foreigners to have to sell these treasury assets and other forms of US dollar assets, which normally they wouldn't do if the dollar system was functioning even closer to normal rather than in this abnormal shortage, or it's not abnormal for the last 15 years, but abnormal, it's not, it's a malfunctioning system.
So Jeff, moving on to a couple, let's say, different examples then. Obviously, Evergrande has been on the lips of a lot of people lately, and it's been compared to the next Lehman moment by some people. But why is that actually not the case? Is this simply because of the let's say the relative size of Evergrande compared to the world economy now, or is it simply a matter of the confidence game not escalating to the point that it did in 2007, 2008 that started with Lehman?
Well, there's also a couple of background considerations that make it completely different than Lehman Brothers. Number one, this is not a surprise. This is not something that people weren't prepared for. Mm-hmm. And number two, this is actually a policy choice of the Chinese Communist Party, which this is an intentional act. So it's not Lehman Brothers at all, which was the response to a broken monetary system. This is actually an intentional provocation to enact what is essentially a transition from a capitalist phase to a socialist phase. Mm-hmm. So it's the comparison between Evergrande and Lehman just breaks down in every kind of way. And what I mean is that, look, the Chinese economy, after Mao Zedong made a mess of it in the 60s and 70s, Deng Xiaoping came in and said, look, if we're going to survive as a communist party, we've got to embrace a capitalist phase. And that started in the late 70s with special economic zones in places like Guangzhou. And that was the first, and Wuhan, believe it or not. So China went through a multi-decade capitalist phase, and which was given a tremendous boost when the Soviet Union dissolved in the early 1990s, which the Chinese Communist Party said, in order to avoid repeating the Soviet fate, we need to ramp up the capitalist phase throughout the 90s and middle 2000s. So the idea was we're going to create a wealthy society. And once we created a wealthy enough Chinese society, we could then turn it back into the socialist phase from which it came. But The idea, really, the 2008 crisis sort of interrupted that capitalist phase. And in the initial recovery period, which wasn't a recovery period because of the dollar malfunctioning, the Chinese thought, well, okay, this is a kind of a blip. This is a sort of a speed bump in the road. We'll get right back on track. But by 2011, when another dollar shortage hit, and when the global economy much of it went into recession again in 2012, the Chinese went, this might be it for the end of the road for our capitalist phase, because the global economy does not seem to be functioning in the same way it used to. And therefore, China can't really take advantage of being the world's factory. Because if the rest of the global economy is harmed permanently by this monetary breakage, the Chinese are not going to be able to continue the capitalist phase in the way that they had up until that point. And so from that point forward, which coincides with Xi Jinping taking over, and what was really a surprise that Li Keqiang was supposed to be, he was Hu Jintao's protege, but instead Xi took over. And ever since then, the Chinese have been slowly enacting this transition from out of their capitalist phase toward a more socialist phase. And among the strategies they employed, which first showed up in 2013, was they were going to allow corporate defaults. The first one was Shanghai Chiori Solar, which if you look on a currency chart with CNY, what you'll see is it appears right at the top. So ever since 2013, early 2014, CNY has mostly gone lower as global growth disappears because the Chinese are more and more transitioning. And Evergrande is simply the biggest and the latest one in this transition phase that started many, many years ago. So it's not Lehman. It's not a surprise. It's not a monetary breakdown. It's a policy choice where Xi Jinping is saying, we're going to start our socialist transformation by targeting the excesses of the capitalist phase. And that explains why the recent crackdowns, as well as why they're allowing Evergrande to get itself into trouble, because it is one of the prime examples of excessiveness in the capitalist phase. And so it kind of, you want to make this transition, you want to make an example out of somebody or several somebodies, because Evergrande's obviously not the first.
So Jeff, when we hear people talk about how much debt China has, does this pose a bigger risk to you from, let's say, an independent standpoint, or is it more managed by the CCP?
It is, it's the debt levels and really the excessiveness of their capital, especially the last couple of years of their capitalist phase, that initial recovery period after the Great Recession, which, that's where a lot of that debt came from, because the Chinese Communist Party still thought that, they were going to go back to the pre-crisis world and everything would be fine. And so they reached into the neo-Keynesian textbook, which told them to do all of this debt-funded stimulus. And that's what they did. Except when they got to 2011, 2012 and realized that, the economy wasn't recovering across the rest of the world. And that meant that there was significant capitalist danger in their perception. In fact, this is probably the biggest, most critical capitalist danger, which is debt levels that are absolutely obscene. And ever since then, they've been trying very methodically to let a little bit of the air out of the balloon at a time, just a little bit, to make sure that it doesn't go into some kind of crisis that they can't control, because that's where not only does the Communist Party end up being Soviet Russia in 1991, they also end up being, which would be worse, Japan 1989. Mm-hmm. And so they're trying to avoid both of those fates as best as they can, but realizing they have to let some of that debt go off. They have to expunge some of that debt. Otherwise, they won't be able to pull off, which is essentially this bait and switch, which is going back to the socialist phase without it devolving into a very messy transition. So that's why I call this managed decline, because what they're attempting to do is, again, very methodically, very periodically, incrementally transition and do it in such a way that most people don't realize that it's actually taking place. Because once people start to realize, that's when you get into real trouble and potential for volatility, to put it mildly. And that's really what Xi Jinping is focused most on, is making it through this transition phase without becoming Japan or the Russia in the early 1990s.
So Jeff, now that we understand a bit more about how, let's say, the Eurodollar system works, all of these different monetary phenomenons, how do we go about protecting or growing our capital to protect ourselves from inflation or deflation? I know you're a big fan of crypto, but I'd like to get your opinion on gold as well. Is it gold and crypto, or gold or crypto?
Well, to be clear, I'm a big fan of crypto technology. I am no fan of crypto at these prices because I think there are two competing interests at work here. Mm-hmm. I think most people have bought into the Fed is printing money, the dollar is destroying, the inflation narrative. And like 2017, in 2020 and 2021, people have been piling into crypto under the mistaken impression that money printing is going to unleash this tidal wave of inflation. So prices in crypto, to me, are way out of whack with the technology. Now, the technology behind digital assets is being driven by a very, very different set of circumstances. And that's this euro-dollar breakdown. Because historically speaking, whenever you see this systemic tight money, prolonged tight money period, that opens the door for competing currency standards. And crypto really is taking nothing more than what is the latest example of ledger money, which spans 500, 600, 700 years back into the past. So it's really, even crypto is nothing new. It takes a modern format and digital currency that's traded electronically. That's obviously new, but this ledger money, the idea is ancient. And really that's what's happened. So you have these competing interests where people are piling into crypto that they don't understand what it actually is, but they heard they need to because they need to protect themselves from this tidal wave of inflation that the Federal Reserve has printed up. And then you have the structural innovations and technological development underneath in all these various competing currencies that is being driven by this essentially inelasticity in the eurodollar system that has lasted, and all of the other negative factors, the eurodollar, like lack of transparency, that has opened the door for digital currencies to essentially thrive regardless of their current the current price of whichever coin it might be. So I don't think I really answered your question. So, what do you do? I think, just keeping it in general terms, mm-hmm. What you want to do is understand the situation. You want to understand so you don't make, kind of big mistakes. Like I think a lot of digital and cryptocurrency people did, gold too, in 2017, which was chase that same story. Because this inflation, Fed money printing, this is nothing new. We've heard it all continuously for the last 13 years of QE. And it really kind of reached a head, at least before now, in 2017, along with globally synchronized growth and the idea the dollar was going to crash and Chinese were going to take over, whatever it was. And people piled in the crypto, and it didn't work out so well because that was never really the case. Mm-hmm. So in terms of investing and looking ahead of how do you want to, maintain or in most cases, you want to grow your capital, I think you have to start by understanding the situation as it is, because then you'll have a much better idea of what your risks are and what your tolerances can be. And yeah, I do think gold is an important part of this entire story, because what we're really talking about is the potential for not just a monetary error, but a further monetary error. And what is gold if not the original form of money? Now, it's not used as money nowadays, but it has given its historical significance, by the financial system for a very good reason, which allows it to be somewhat of a very, useful hedge against, some of the more extreme forms of monetary errors. So even if it doesn't end up being money itself again, which I don't think it probably will be, it is still an important part of recognizing where we are and where we would like to be, and realizing that could be a very messy transition.
Absolutely. So, Jeff, where do some of the biggest risks lie for you right now? You have a very interesting perspective in, as you said, trying to really understand the problem. So, is it basically this scarce collateral market? Is that one of the biggest issues that you see for the global markets right now?
That is one of the most visible forms of malfunction in the eurodollar system, is the fact that we have an ongoing collateral shortage, which is one of those counterintuitive things, because you think, how can collateral ever be short? And it's really one of the ways that this really ridiculous eurodollar system actually has worked for many, many decades, is that collateral is just as fungible as currency. In fact, it has become its own currency system with its own currency. There's actually a collateral multiplier. As absurd as that is, and as absurd and ridiculous as that sounds, that's actually the case. So you have this fungible fluid collateral system that's always, it hasn't been able to solve what is essentially a shortage in collateral over the last 14 years. But primarily, you step back and what is the real big problem here? And that's really the banking system itself, because this eurodollar system, ever since its earliest days, has been bank-centered money. And what that means is if banks are adding to their balance sheet, generally speaking, however they're doing it, whatever form that takes, whether it's a derivative, whether it's repo, whether it's something else, whether it's just straight lending, that expansion in their balance sheet is essentially monetary growth. That's the equivalent of monetary growth. And so if you have banks that are expanding their balance sheets by taking on more risk and doing all these other very interesting activities, then you have monetary growth, you have economic growth, and things appear to be doing well. So primarily the problem going back to August of 2007 is that bank balance sheet construction has changed. In many ways, it's been impaired so that banks can't do what they used to do beforehand. And so even the collateral shortage itself is a symptom of that problem, which is a sort of aggregate bank balance sheet impairment, which can't be solved by the fiction of bank reserves. It can't be solved by sentimentality. It's really a function of this eurodollar, inherently unstable eurodollar system, and the fact that banks and money dealers aren't willing to do the things that they used to do before August of 2007.
So when we hear about, let's say, Powell coming out and tapering, what is that signaling to the market? Why are most investors so scared of that announcement?
Well, because again, we've been taught that the Fed is the center of the universe, and without the Fed, we all die, or this dire consequences, right? And and he's taking advantage of what sounds like it should make very perfect sense, right? Mm-hmm. The U.S. government has gone crazy. It has issued tons of treasuries, right? Trillions in treasuries. And you stop and think, and people have told you over and over on the news, if the Federal Reserve isn't buying a lot of those treasuries, who will be left to buy them? Therefore, just before even getting to inflation, just on a supply-demand analysis alone, we're supposed to believe that without the Fed, the treasury market would be toast. But this is another thing that we've heard time and time again. When you understand the situation, which is collateral shortage, among other things, in the reason in how treasuries are viewed outside the United States in the offshore eurodollar market, you realize that the demand function is completely, totally independent of the Federal Reserve's bond buying activities. Again, as I said, you don't even need to take my word for it. The Fed and anybody else have done all these quantitative easing studies where they prove or they show exactly what you can show yourself if you just pull out a chart of the Treasury the 10-year Treasury curve. Interest rates are independent of quantitative easing because it's these monetary factors in the shadows which ultimately determine this demand for treasuries. And so long as that's deflationary, there's going to be demand for it, no matter how ridiculous the government borrows for whatever it's doing at any particular time. But yeah, most people believe that the Fed is all powerful and the Fed wants the taper, then this must be something we need to pay attention to. And it goes along with their expectation story, which is essentially, look, they want you to believe that they fixed all of these monetary problems since March of last year. They want you to believe the economy is moving forward in the right direction. And they also want you to believe that not only is all these things good, and we're moving toward a 2022 where everything is getting to the point where we can actually say recovery, we're back to normal again. And so by tapering QE, they're sending a signal to everybody, this again, expectations policy, that things are really good. Things are not only so good, the Fed is so confident in the future, they're willing to taper their ultra special QE. They're willing to even talk about rate hikes and things like that. When, again, we're not supposed to remember just a couple of years ago when they did all these same things and it turned out to be the exact wrong interpretation of where things stood. We're supposed to just believe that taper is a very powerful signal of confidence in the future.
When you say that they misinterpreted a signal, let's say, and thereby, let's say, taking the wrong action, can you give us another example of a policy decision based on misleading data like this, Jeff? What about if we take something like the unemployment statistics that they're basing policy around?
Yeah, the same mistake 3 years ago. Go back to 2018 in your memory. And what you will remember inevitably is inflation. The Fed needs to be hawkish. It needs to be aggressive. We're going to hike rates. And the reason they did so is, look, if they were actually a central bank, all they would say is, look, we just need to take a look at the money supply and we'll know if there's excess money or not excess money. But they're not a central bank. They can't define money. They haven't been able to do so for decades. So what do? You have to ground your monetary policy in something. And so what they decided with this expectations policy is that, look, we'll look at some of these economic aggregates like the unemployment rate, and that will tell us whether or not we're doing a good job. Because if the unemployment rate starts to go down and goes down to a particular point, which they call maximum employment, then that will tell us that, yeah, we don't understand the monetary system, but it must be working because look at the unemployment rate. It's telling us the economy is operating at full capacity. So the Feds looked at the unemployment rate really starting in 2014 and 2015 and said, well, the unemployment rate makes it seem like our monetary policies are working. And then you get to 2017 and 2018, the unemployment rate goes lower, 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 and eventually gets to a 50-year low. They think our policies must have really worked. It took a long time, but they must have really worked very well. And that means that we're going to start seeing some inflation. So Jay Powell's Fed, as he takes over from Janet Yellen, needs to become even more hawkish and more aggressive because the unemployment rate version, basically just the unemployment version of the economy said, whatever's going on in the monetary system, it must be working really well. And we're reaching the point where we need to change policy, which is what they were doing in 2018. Now, the reason that was wrong was because you looked at the stuff you can't see, the shadow money system, and that was telling you, no, the monetary system, if you're looking for money and inflation and economic growth potential, the monetary system, the entities that are actually working in that shadow money system were saying, we don't see what you're seeing, Jay Powell. We actually see the opposite. We see trouble lurking under the surface. Deflationary potential is rising, not inflationary potential. And you saw that in any number of ways. A prime example was in June of 2018, when Jay Powell was even more hawkish at a Fed meeting, and the Eurodollar futures curve inverted for the first time. This is June of 2018. What the Eurodollar futures curve was saying, the monetary situation was deteriorating so rapidly and so badly that they were betting, people in the monetary system were betting that Powell was going to cut, not raise rates in the near future. And think back to middle of 2018, nobody would have thought that, because that's not the message that you got from the financial media or anywhere else. But yet this deep, sophisticated, liquid marketplace, one of the biggest markets in the world, said, there is trouble here, and there's a lot of trouble here. We don't care one bit about the unemployment rate. The monetary system is behaving in a very troubling, alarming fashion. And that's why you saw other curves like the Treasury curve flatten out rather than expand as steepen as it should have. And a number of related indications throughout the markets, which you put them all together, what they said is deflationary potential was rising. And that's exactly what happened in 2019. Maybe everybody else was caught off guard by Jay Powell's rate cuts when there were supposed to be additional rate hikes that year, but the markets had been predicting that very outcome from the very early stages of 2018. So the Fed, because it's not a monetary central bank, looks at the unemployment rate and says, we must be doing a good job because we don't really know what's going on in the monetary system. When the monetary system said, you guys are crazy, you have no idea what you're talking about. There's actually trouble tightening going on in the monetary system, and that's going to be trouble globally, as it was. You saw places like Germany and Japan hit recession in 2018. China slowed down, all these other things that were, when you look at them as a whole, interpret them through the lens of the Eurodollar system, you could see how Jay Powell was making that mistake by focusing on the one statistics and not really understanding the monetary mechanics, which is really, again, that's where people have so much trouble. You're saying the central bankers don't know money? What I'm actually saying is the central bankers know money the least. They have the least amount of knowledge of what's going on in the monetary system. And that 2018 episode, and there's a lot more to it, but that 2018 episode is a perfect encapsulation of the fact that they don't know what's going on in the monetary system. They were looking in one way when the monetary system itself, and you could tell the whole time, it was thinking the exact opposite way, and they were correct, not Powell, not the unemployment rate.
So again, it comes back to basically flawed metrics that they're looking at, which informs their decisions one way, which exacerbates the problem.
Exactly. And really, I don't want to give them too much sympathy here, but you can understand why they're looking at the unemployment rate, because again, if you're a central bank, you don't need any of that. You actually do money. You just look at the money supply and say, okay, the money supply is excessive. We're going to cut it back a little bit, and therefore we'll know down the road because we're looking at the very guts of the system. Mm-hmm. But if you can't do that, and you haven't been able to do that in 30, 40, 50 years, you kind of have to do it another way. You go, okay, we're going to look at the unemployment rate and hope it's not steering us wrong. When in fact, that's really what was going on. I mean, Donald Trump got elected president by saying the unemployment rate was faulty, which was absolutely the case. Mm-hmm. The participation problem in the U.S., which you would have known was valid, legitimate, by looking at all this, Eurodollar stuff, this hidden money stuff, which would have told you that, Jay is making a huge mistake in 2018. And where that's relevant obviously to what's going on right now is the Fed is making the same sort of mistakes in the exact same way, even though this was just a couple years ago. They're following the unemployment rate lower and ignoring all of these other monetary signals because they don't know what else to do. Now they're not hiking rates just yet, but that's really the point. They're going to taper QE so that they can get to rate hikes, they believe, by the middle of next year. And the market over here is saying, you guys are making the same mistake again.
Mm-hmm. So one would think that they should be course correcting at some point, should they not?
But then you look at the Japanese example, as you said before. I think it's great. By my unofficial account, I think the last couple of QEs are 25 and 26. So, it's about accountability, right? They should be making course corrections. But when you're doing this expectations management policy, it really requires that you play up that you're this all-powerful, all-seeing institution. It's almost like the communist government in Russia during the 70s and 80s. You can never admit a mistake because as soon as you do, that illusion just dissipates, right? As soon as you say, maybe this QE isn't working as well as we thought, the entire thing, the entire worldview and framework just falls apart because it absolutely requires everybody buying into the myth. And you can't admit mistakes. And so there's no way to correct course because you have to stick with. And not only do you have to stick with it, you have to, every time you do it, you have to make even more outrageous claims. Mm-hmm. Oh, this is even more powerful than the last. It's even more guaranteed to succeed, which of course only leads to greater and greater failure. But you can't. There's no accountability. There's no way to get out of that worldview that doesn't require starting from scratch. And that's really the problem here is that when you look at, just the Eurodollar system itself, as well as how central banks aren't central banks and what that actually means, what we're really saying is that the thing has been malfunctioning for 14 years because there's no alternative to it available. And if we really want to get out of this mess, we need to start thinking about a legitimate global currency system that actually could be stable and could function very well. Mm-hmm. And that's not a small order. That's a huge, huge, tall task.
Absolutely. So is there promise of any digital central currencies that are making steps towards this, Jeff?
Well, the central bank digital currencies are, essentially, there are two things. There's central banks trying to catch up all these years later to what the private system is doing, as we said, in mm-hmm. technological innovation and forwarding the infrastructure for digital currencies. So they're trying to make it appear as if CBDCs are some kind of alternative when they're really not. They're actually a ridiculous joke. And really, central bank digital currencies are meant more for surveillance capabilities than anything legitimately elasticity or any monetary function. So even the CBDCs, central banks are looking in the wrong direction and drawing all the wrong conclusions. Mm-hmm. That said, on the private side, some of the digital technology and decentralized finance, DeFi is another thing, blockchain, all these things, absolutely, there is so much powerful potential in these things that if done right and if made more robust and more dynamic and more responsive and more whatever else I can come up with,
trustworthy,
something like transparency is a big part of this. Let's look at the flaws of the Eurodollar system and learn from what the mistakes that were made and correct them. There is definitely the potential to do that. The problem is I don't think they're anywhere close to being a realistic alternative. And I know that saying that, here we have El Salvador accepting Bitcoin as legal tender, mm-hmm. but that's really out of desperation more than, hey, Bitcoin is caught up to in reaching its prime time level of achievement here. It's more El Salvador has a massive dollar short problem, and they're just looking for any kind of currency that could fill it. Mm-hmm. So I think in digital currency has tremendous amount of, and crypto in general have tremendous amount of potential, but we're not anywhere close to realizing any kind of a global system, an alternative, a legitimate competing alternative to the Eurodollar system. Mm-hmm. That's way down the road.
So Jeff, two terms that we've used a lot today is money and currency. Do you think there's a stark difference between the two, and do you differentiate in any way between money and currency?
Well, there should be, right? I mean, that's the point. We have these different terms for a reason, and that's money was money. That was the medium of exchange. And currency was always a derivative of money that usually was convertible into money. So it was a token that allowed you to obtain money that could itself be used as its own medium of exchange, but was always derivative of this other monetary form. That's why it was currency and not money itself. Now, obviously there is no distinction nowadays. It's basically we have a non-money system that all operates on tokens, which, we can get into a long history of that, going back a long period of time where that, people have said, economists have said, that's the way it should be. The commodity money was a mistake and, whatever. So money and currency, they're supposed to mean something different, but nowadays there is no money. There's basically only tokens. So, and for all intents and purposes, it really doesn't make much of a difference now, except looking ahead at maybe introducing something like a monetary component to a future global reserve standard, and whether or not that's actually a good idea. I think it is. But that's certainly a debate that probably should come back. We need to understand the significance of money versus currency because it does mean something. It's not a trivial distinction.
Would you add maybe not only medium of exchange to money, but also store of value?
Absolutely. Money has those three roles. There's medium of exchange, which I think is the primary purpose, and it's a very important one. And then you also have what the unit of account, which kind of goes along with medium of exchange because it's a commercial. It's tied up into the commercial part of the global economy. And then you have the store of value. And store of value is somewhat of a tricky one because you're talking about a couple of different forms of store of value and a couple of different purposes. And the way the Eurodollar solved these monetary functions was that it separated itself entirely. The Eurodollar system is not even a store of value. It's almost strictly a medium of exchange and a unit of account. And the store of value functions are financial assets. So it's kind of offloaded store of value into these other financial assets. And so there's an argument and a debate to be made about whether that was a good idea, if that's a legitimate store of value function to money and whatnot. But yes, store of value is an extremely important part of any monetary component because you don't get paid the same day you spend the money. There has to be, at least in the short run basis, you want a dependable monetary form that it's not going to change prices wildly in a short run period of time. Otherwise, it will be a huge impediment and disruption to legitimate commerce. So store of value, whether we're talking about longer term or not, but even just in the short run, it is an absolute necessary component to any monetary system.
Well, Jeff, there's a heck of a lot here to digest for our listeners in this conversation. I really appreciate you being willing to highlight the problems with the Eurodollar system and try and explain it to us. I'm sure we'll have a lot of questions, but I look forward to hopefully being able to speak with you again about some of these intricacies.
Yeah, my pleasure. And again, I think the message I'd like to send to people is, look, first of all, you don't have to take my word for it. A lot of this stuff is available, very public, and you can find, information if you're willing to do the research. But really, what I'm trying to get people to do is, look, you probably already realize that there's something wrong or something missing in this whole QE business. It's really just have an open mind that what you've been told the Fed does or any central bank does may not be what it actually does. And then if you do your own evaluation and research from that open-minded perspective, I think what you'll see is that all these things really do start to fall into place, and the world actually does start to make sense. Doesn't mean you're happy about it, but it does start to at least make more sense. And I think that's really what I'm asking people to do, is just have an open mind and ask questions. And I'm very confident when you look for the answers that you'll draw these same conclusions.
Yeah, I think a big problem that we have nowadays is just trying to find the right source for these answers, because you can really find any data to reconfirm your viewpoint, no matter what it is nowadays.
Yeah, and it's almost, look, we don't even know how to evaluate the data. Like, for example, I'll give you a perfect example, which is interest rates themselves, something very basic and fundamental. We're taught to believe that low interest rates are stimulus, and that's not the case. Low interest rates, historically speaking, have always indicated tight money in the real economy. And so we can't even evaluate the evidence properly because we've been taught, and the financial media reinforces the message over and over that, the Fed has lowered interest rates and that's stimulus. That's a good thing. When you see prolonged periods of low interest rate, that's a bad thing. That's a tight money period. So we don't even know how to evaluate. And that's really the problem most people have is, you don't even know where to start and how to interpret what's going on in the world. And it's, even the financial media, because of this is such a complicated discipline. Mm-hmm. You work in the financial media, where do you get answers from? You ask about what's going on with interest rates, you're going to call up a central banker because you're told to believe that these people know what the monetary system is up to. So it's really difficult for people. And believe me, I'm sympathetic to this and completely, is that you don't have a worldview to frame all of these things and properly so that you can really interpret them. That's why I say you have to start by asking questions, because it's very hard to, take yourself out of the central bank model, the current model, and get your mind right and wrap around these concepts. What I'm basically saying is that these central banks haven't been monetary agents for over half a century. Mm-hmm. And you have not heard anything about this anywhere. And that's such a huge intellectual and intuitive leap to make that most people just frankly can't make that leap, because how can that possibly be 50, 60, 70 years and they've been lying to us? That's, essentially that's what you're saying. And I believe that if you do take the time and do the research, you will come to that conclusion, because that's the only conclusion you can possibly come to. But it's very difficult to get started, and it's very difficult to really be able to interpret the evidence.
Mm-hmm. Yeah, like you say, interest rates are a perfect example. If they're low, that could mean that there's no demand for money. But on the other side of the coin, it could also mean that the lending standards are too tight, so there's no supply of money to be able to facilitate that transaction, right? And
the other way you look at it is, treasuries or government bonds, they're the safest, most liquid instruments. If the price being paid for the safest, most liquid instruments is through the roof, what does that tell you about safety and liquidity? Mm-hmm. Right away, it tells you something you probably don't want to hear, especially if you're Jay Powell. So if safe and liquid, and again, this is historically validated in many different jurisdictions all over the world. It's always, Milton Friedman called this the interest rate fallacy for a reason, because you're told low interest rates are stimulus, but yet historical experience has shown. Think about the United States in the 1930s. During the Great Depression, interest rates were low, not high. They were low because safety and liquidity were paramount during that period. Conversely, the United States in the 1970s, inflation, too much money, excessive monetary growth. Interest rates were double digits eventually. So it's exactly opposite to what you're told. And again, it's I understand why people aren't able to make sense of what's going on in the world, because in many instances, you're told the exact opposite the way things happen. And the fact that message is reinforced everywhere, all across the internet, all across the television, all across financial media, the news, they always tell you QE's printing money. So it's hard to say, how can it not be printing money? How can everyone possibly be wrong about it? And that's where, let's divorce ourselves from what other people are saying and just let's focus on the evidence and the data we have and market behavior. And when we put a consistent picture together and put that together with the scholarship that's available, what you'll see is exactly what I'm telling you, is that central banks aren't really central banks. And the monetary system, there's this offshore hidden shadow money system out there that has been determining our economic fate for a very, very long time.
Mm-hmm. Well, Jeff, I have a million more questions for you, but I'm sure everyone's heads are spinning here. Of course, you write a good amount of columns, and you also do some excellent videos over at alhambrainvestments.com. And your Twitter handle is Jeff Snider _AIP. You post a lot of great stuff there. Of course, we'll have both of those available in the show links as well. Jeff, thanks so much for your time and sharing your info with us today.
My pleasure, Tom. Thank you very much for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.